Hi, welcome back to Academic Markets Insights. We have a special treat for you today. So, I'm pretty excited about it. When Dr. Rose said to me, "What about perpetual futures?" I thought, well, what about perpetual futures? I know nothing about perpetual futures. What, Dr. Rowe, are you talking about? So I was super excited when he said, well, let's do a video. And I thought, woohoo! So with that excitement, Dr. Rowe, please take it over because I am desperate to know what these things are.
Such excitement over perpetual futures. And perpetual futures, this is one of, we're not officially calling them this, but I got to go to my old employer, the CBOE's Risk Management Conference very recently. And there were three topics that were discussed, and when they were discussed, the people on the panels or in the fireside chat, et cetera, would say these are things that we probably need some more education out there about. That's what we do. So we did one on buffer protect ETFs, went up a couple of days ago. And the perpetual future one is kind of like the second and a third. We're going to do one on, we're saving the most complex for last, which is auto-callable exchange-traded funds. So that one will come out in a couple of days. But for now, with respect to perpetual futures, it's a contract. It is what it says it is. I like to joke that if this were on an exam and I asked the question, what is a name for a futures contract that never settles? Perpetual future. It is what it says it is. So the only way, when you get your profit or loss from having a long or a short position in a perpetual future, that occurs when the trade exits. Now, traditional futures and most financial futures started out on a quarterly basis. We have monthly for energy. We've got different months based on the growing season for the agricultural futures. But in the financial future space, it's March, June, September, and December expirations. And we're doing this video in April right now, and the front month future is the June future for the S&P 500. If we wanted to hedge our S&P 500 exposure through the end of the year, the most liquid future right now is the one that expires in June, even though there is a December future available. And most firms, for liquidity purposes, will use the June future. And if they want to remain hedged, they'll roll that to the September future and then roll that to the December future. You don't have to do that with perpetual futures. Perpetual futures will have a very close beta with the underlying, and the way that they are funded causes that to happen. Now, the traditional futures, they would have a fair value based on the timed expiration and interest rates, et cetera. We used something called a funding rate mechanism to come up with a fair value for perpetual futures. And it's determined by a funding rate that is charged to the long and credited to the short positions multiple times a day, and multiple times a day, 24/7 as well. So these are mostly associated with the crypto-related markets, and it's a way that you can get leveraged exposure to Bitcoin or some of the other more active cryptocurrencies out there. They do a very good job of mimicking the spot price action, and when we go through the example, you'll see why. And traders will like perpetual futures. As I noted, you don't have to worry about rolling. You don't have to worry about the time frame that you're hedging out. There are risks. You do put up margin. If you exceed your margin, you can experience liquidation. Do keep in mind these are 24/7, so you could wake up one morning and not be in a position anymore and not be a happy experience. Another risk is accumulating funding costs for long positions. We'll see that's not that expensive, but you are paying a very small amount of interest on the margin amount 3 times a day for most of these contracts. So that could add up for you, but it's a pretty small number. And then finally, I do think with the way that the fair value is calculated, that there may be a higher possibility of price deviation for perpetual futures versus traditional futures during periods of higher volatility. Just because there's not the same sort of buy the S&P 500, short the futures, that sort of fair value relationship that can be taken advantage of quite as easily with perpetual futures. Now, they are highly leveraged and have a margin requirement. And the leverage varies. One description was 5 to 10 times, depending on the exchange. I'm going to talk about Coinbase's offering. Depending on your level of experience, they may only allow you 3 times leverage, which when you see how small the contract size is, it's not that not that big of a deal if you're getting 3 times leverage or 10 times leverage. The dollar amounts are not that different. So the Coinbase contract, they call it a nano contract, and it's 0.01 times Bitcoin. So if Bitcoin's at 75,000, the contract size is $750.
Well, I've enjoyed so far that all of the naming conventions have been very descriptive. Nano contract,
Little
0.01.
bitty.
I mean, it's just, and I like the perpetual futures. Futures contract that doesn't settle. I like these terms.
We're not using a lot of trader speak.
No, it just,
it's nice. There's not
I think the #1 fan will love this.
Yeah, it's not like we're, there are, we have, regular call options, put options, and then we might have knockouts and all those other type of things. But the name doesn't necessarily describe what you get. Right. You get what you get. You got a future that never expires. However, if you were to buy, and I'm going to go through a specific example in a second, but if you owned one of the Coinbase contracts, or 100 of them, doesn't really matter, every 8 hours, you are paying a funding rate of 0.005%. And this is based on your margin. So a funding period every 8 hours, and that should keep the contract price in line with the underlying market. They should be somewhat in line with each other. If they get way out of line, there is a possibility that, depending on whose contract you're trading, that the long could end up having to pay more to the short, or vice versa, depending on how out of line it is with spot. The legal status, just one last thing with respect to these, they're not banned, but the CFTC does not have any formal rules in place right now. They're kind of working on formal rules. Now, exchanges may list them through what is a self-certification process. The CFTC would look that over. And when the CFTC looks that over, if they don't have any issues with it, they basically, I think they refer to it as a no action, which means we don't have a problem with it. Go ahead and do your thing. I'm probably oversimplifying that, but if there's no CFTC objection to this, then you can actually list perpetual futures. SIBO did not, share any big plans or anything about what they're thinking about doing, but they talked about these at their conference. So we may see, as opposed to Coinbase, which is a very good organization, we may see one of the old school traditional exchanges listing perpetual futures on digital assets sooner rather than later.
Sure.
So with that, boom, you take us home.
We thank you so much for joining us for this very good explanation of what perpetual futures are. We thank everybody for seeing us through to the end. We enjoy doing these videos. We like talking about new things that are coming out. I know we are starting a queue of different topics that we have been requested, so we are happy to keep adding more to the list because we enjoy doing that. So if you do have any suggestions, please pop them into the comments. With that, we thank you so much. If you enjoy this video, please hit like, and if you're not already a subscriber, please hit subscribe. Thank you.